With the markets having officially entered a correction, albeit briefly this week, investor sentiment in extreme fear, we talk about the importance this week of the next hard thing. So when we talk about the next hard thing at 10 Capital, we're not talking about something that we're living in fear of or we're anxiously awaiting. We're talking about the key to the right path for us as investors. And so while a lot of people are always worrying about what is that next scary thing that's going to happen, we've shared that chart in the past with all the various headlines over the S&P, there's always something out there that people have to worry about. That's always been the case, and it has never stopped the economies, companies from continuing to make progress again over time. For us, when it comes up around here, we're usually around the topic of market timing. When is making a trade or changing something around really market timing, and when is it doing the prudent, correct decision? Well, for us, it really depends on how does it make you feel. It feels good to buy stocks while they're racing up. It feels good to get out of stocks while they're going down, and yet we know counterintuitively that we really need to be doing the opposite. We need to be selling the rips, buying the dips, as they say, to again, better our chances of being those people that in fact buy low and sell high. And that usually requires doing things that again, go against the crowd, go against what seemingly makes sense today to do what is counterintuitive, but again, historically has been shown to be the prudent course of action over time. So for us at 10 Capital, we're very proud, number one, of our ability to be an empathetic team. We hear all the time from clients that one of the things they value that we do, which is great to hear because it's one of our key principles, is the importance of building relationships, getting to know them. What do they want? What are they hoping to achieve? Helping them build a plan and make that connection. And so while we want to be empathetic, and particularly during times of market volatility when emotions are running high, that empathy does not equate to enabling destructive choices based out of those emotions. And so ultimately the client's always the boss. We want to be here to, again, not just spew old adages. I think that's where the industry's too often fallen short, but really back things up with a historical understanding, with some common metrics today to show you why you should have faith in the ability of things to move forward. If we're focusing on empathy, not enabling, is point number one. Number two then, along that is, how do we then stay the course? And this is about defining the fear. I think for most people, while volatility, again, whether this is turbulence on a plane, a boat that's tossing in the waves, I hate that. It makes you immediately have that fear of mortal danger within you. What they really need to keep in mind, again, is while it might be uncomfortable in the boat, we're always using nautical analogies around here, it's still safer on the boat than jumping into the bottom and sinking to the bottom of the ocean. It's very calm down there. There's no volatility. It's also the thing you actually fear. And so again, helping people walk through some of the more subconscious thoughts that are driving those emotional decisions, such as, well, what if the market doesn't bounce back in time? To us, that's a planning issue, not an investing issue. There should have been income there to meet people's needs. There should have been money put in a defensive position if there was an identified need or the anticipation of perhaps, not about getting the market to give us something over a set amount of time. Markets simply don't move in that way. The other thing I've heard people say countless times over 3 decades is, well, if it keeps going down like this, there'll be nothing left. That's mathematically true. It's just not historically accurate about how markets actually work. And so helping people, again, understand what is point number 3. What are those market realities? Well, one of the first realities that we've been talking about is pullbacks happen. And while the media, investors, and everyone tries to make sense of them, if people are honest, I've heard plenty of analysts talk about this, there's a lot of times where there isn't a direct causation between event and market behavior. And you just got to get comfortable with that. Furthermore, while we certainly understand that for investors, they want to make money over time, looking at that time frame and making sure it's not too arbitrary is critically important. Why? Well, as we've shared with you before, approximately half of trading days are negative. If half the time you're worried about getting in and out because of what the market may be doing and is it working, that's going to be a problem. 1/3 of months historically have been negative, and about a quarter of years have been negative. And so there are just seasons you're going to need to get through to be able to get where you want. So if we look at this chart that we've been beating you over the head with for the last few weeks, which is the intra-year drawdown chart, you can see again, not only is the average drawdown 14% a year, but I wanted to call out a few other things, because again, every time the market shutters at all, and truly, with about 5% down year to date, this isn't the gnarliest thing by a mile that we've seen. People immediately begin fearing the worst. If you look at this chart, you'll see that in the last 45 years, there have been 9 bear markets defined by a drop of 20% or more. People are fearing it, to bring up that headline chart over the S&P, all the time with some new news story. The fact is, it only happens about 20% of the time. Of those, only one reached a 40% drawdown. That was in 2008. Again, that's the thing that I think ultimately everyone still has in mind. It's got some understandable PTSD from. Of those 9 bear markets, only 2 ended the year still in the bear market. Or put another way, if you get out at that time, you're probably missing out on quite a bit of a rebound and upside within the markets. And so when we talk about staying the course, it isn't just to spew an analogy, it's because that's what has historically backed up the fears that every 5% is going to be a 10, a 10's a 20, a 20's a 40. It's just not borne out by the stats, and you can look at that if you look at this chart. So if we're not just going to follow our emotions to enable those bad decisions, if we've got our fear properly defined in large part through the help of historical context, what is the plan? And we've been getting this, and we tell clients the same thing every time, which is we already did it. So we're not going to get to a place where we're being hyper-reactive. We've been writing these commentaries for some time. We never can give specific investment advice within these. Nonetheless, if you looked at it, we've been calling out some particular concerns. The economy has been slowing down for months now. We've called that out. Inflation has been sticky for months now. We called that out. Valuations have been high for months now. We called that out. And so this doesn't come to a great surprise to us. What probably will come to a great surprise to a lot of people is a lot of those other things that, again, we talked and told people to consider last year: fixed income, credit, real estate, value stocks, international stocks, are actually having a pretty nice year. So again, if you've been diversified, if you got things set up appropriately, you're not having to ride the same ride that so many investors are, who again huddled into those concentrated positions, tried to become momentum market timers, and now are paying a little bit of a price for that. So to pull this all together, once you've got this appropriate mindset, once you've built in advance the appropriate plan, what then keeps it all together? That's just remembering again what the true ultimate goal is for that portfolio, which was never to experience no volatility. To do that brings on all sorts of other risks via inflation. Your goal was to reach financial independence. And that journey, that path was always going to come with some volatility, none of which needed to derail you, none of which you need to live in fear of. If you ever need to walk through any of this anytime, of course, feel free to reach out. Thanks so much.